Welcome to the last video on the overall series of long-lived assets. In this, we are going to talk about something I think I've already introduced that in the previous video, the concept of fair value model. Something ever occurred to you ever? What would a company do if they have some surplus cash, perhaps out of the profit that they've made or from any other source? Of course, they're going to make investments back into the business. What would they do in case business doesn't need that kind of money right now? Of course, you know about that fact. They are going to make certain non-operating buy some non-operating assets called as investments, and that's again one of the investing items, so to speak, non-business. And typically those non-business assets that they buy are like mutual funds, shares, bonds, bank FDs and things like those. They want some liquidity because at the end of the day, the primary purpose of every company, every corporate, every incorporation is to help the business. And with the unpredictable business situations, you never know when would you need that kind of liquidity as such. So generally non-operating assets that a company buys are in form of short-term, very liquid instruments. Not every time. Welcome to investment property. Investment property is that long-lived asset, such as a plot, a commercial space, a building, which a business has purchased. It's a property, but not from the point of view of using it. Is the business trying to be dealing with in an inventory kind of a situation where the purpose has now shifted from the primary of usage to selling? Well, somewhat like that, not pretty much. I'm not saying that Maruti Suzuki is going to become a real estate player if they buy a particular building in, let's say, Bombay, just to park surplus funds. The point that I'm driving home is a company which is a non-real estate player may want to buy a real estate just to park some surplus funds for a long term and make some phenomenal gains out of the non-business activity. By doing that, of course, we understand that the company is deviating from its core area of production. Let's say in case of Maruti, core area of production of cars, in case of Renvaxi or Sun Pharma, in case of medicine. But as a matter of fact, that exists. And as an accountant fraternity, as a managerial fraternity, we must know how to deal with this kind of an asset, which is not an inventory, because buying such a property is not my main job. Every time I'm not a real estate player, I remain a, let's say, a producer of the cars or producer of medicines. That's not my main job. Therefore, it's not inventory. Rules of inventory won't apply. Plus, that property that I've purchased, that real estate that I've purchased, is also not part of my business to be for a usage perspective. So things like depreciation, things like impairment, things like, all those what you've done, capitalization, etc., won't work here as well. So you need a third category of rules, so to speak, to account for investment property, a real estate brought by a business, a non-real estate player, for the purpose of investment. What do we do? So the video that we're going to talk about right now is a third set of rules. And the model that we are going to follow is called as a fair value model. Fair value is not something new. By following the revaluation model just a minute ago, we spoke about the same fair value, and we said that fair value is similar to market value, and in a particular modeling class we will bring another concept of fair market value in picture. But at this level of financial accounting, they all mean the same. That's fair value, huh? But the model wasn't fair value. Model was revaluation model. What I am talking about is to use the same nut and bolt, same logics of marking to market. What the logics are 99% same as revaluation model, but there is one small change which just changes everything, and therefore it needs another name. The name this time is also the fair value model. So here's what I'm going to say. My revaluation model that was given to me by IFRS, this also is given to me by IFRS. The revaluation model used the fair value as the valuation base. My fair value model also uses fair value as the valuation base. That's a similarity. The difference is revaluation model is applicable for business assets. I took the example of your mobile phone. I took the example of machinery. Right now, under fair value model, I am under non-business stuff. I am into investments. I am into things which are non-operating. That's the basic and the biggest difference between the two models. Okay, I'm gonna just take a minute to illustrate the difference between the revaluation model and the fair value model. If you recall, and I hope that you've already seen the video of revaluation model and we have discussed all of that. 100 was the historical cost. In the first year, the value had gone down, and then in the next year, value had gone up, and then perhaps, then again came down. So we made a very simple point that any change as an increase or decrease above the historical cost, let's say of 100, is into the OCI zone. And any change happening below the historical cost is into the P&L. That's broadly the revaluation model for you. I'm going to make just one small change to convert this accounting into the fair value model. Fair value model. I am going to make very small change and say there is no OCI in my life under fair value model. Don't forget, fair value model is applied only for non-operational assets, typically what we call as investment. If you remember, in one of the quizzes that we took, we made a point that what is a non-business asset called as per accounting lingo? And the answer was investment. Therefore, investment property. A property, a real estate, which is bought for the purpose of investment, which is outside. So therefore, what you're talking about essentially is going to apply to a non-real estate player, because a real estate player anyways is going to look at property as a raw material, as an inventory. Okay, so people, that's it from my side on the fair value model. In the live class, we're going to take some examples and we will also debate as to how is fair value model and revaluation different. I want to kind of just bring up to your mind while you enter the live class. We started the journey with historical cost model. Okay, we graduated to the revaluation model where we say mark to market and things like those. And now we are ending our journey with the fair value model. What is similar to these two is that both are applicable to business assets. Machineries, okay? My laptop, your mobile phones, your laptops, which are used for the business, the primary purpose. Fair value model is applied only on the investments, the non-operating stuff, okay? Does business have a choice? Yes, business definitely have a choice. If business doesn't want to follow fair value model, they can follow historical cost model as well, in which case they're going to do what they do, capitalize, depreciate, impair, and things like those. So people, this is it. It's a very, very small video. In the live class, I'm going to speak to you about, the same concept using a numerical. Just make sure that you are not confused. Historical cost model separate, revaluation model separate, and fair value model separate. OCI doesn't come into the picture in fair value model. It's only for revaluation. All right. The confusion point is both revaluation and the fair value model use the same mechanism. Mark to market, any value could be taken by the machinery even above historical cost. Everything is same except that no OCI is in my life, and I'm talking about the fair value model in terms of investment property. Okay, it's a little manipulative, as you can guess, that it gives me as an accountant the power to bring any gain, infinite amount of gain, into my P&L and color the financial performance very positively or in any manner that I want to. And that's a bit of like a taboo, is like an eyesore for this particular model, and therefore not many companies also prefer to follow it, because it smells rat like a thing. I mean, there's a manipulative thing that comes out of that. But nonetheless, this is one of the things available, and not very old. Like I said, it came into our lives when IFRS came in from 1st April 2016, and in a staggered fashion. Okay, people, thank you very much for patient listening. With this, long-lived asset comes to an end, and you're going to graduate to finally to do something that you were born to do as a manager, the analysis, right? Super excited to meet you in the live class to close this very long, concept of long-lived asset. Thanks very much.